We're going to get started. Firstly, welcome. Thank you for joining us this evening. I'd like to introduce myself. For those of you that I met at the top of the stairs, welcome again. For those that I didn't get to say hi to, hello and welcome. My name is Cassandra Kavanagh and I am what is known officially as the Chief Operations Officer of Rethink Newcastle Financial Planning. I prefer to call myself the Commissioner of Culture. I spend most of my time working behind the scenes, so most of you would not have met me before. I think somebody here tonight said, "Where are you from? Are you a guest?" Yeah. And yeah, the truth is I actually spend all of my time with the team and very rarely get an opportunity to see those people that I'm a part of a team that impact their lives. So I feel very honoured to be up here tonight to present and share with you some of our stories and some of our guests. I really also want to take this opportunity to introduce our whole team. Unfortunately, some of them were unable to join us this evening, but those that are here, if you could just possibly step up just a little bit, ladies, because you're hiding in the background there. So we have some of our admin team here, our client services girls who many of you would speak to often on the phone, maybe not as often see. Christy, you just wave your hand, Stacey, and Jackie this evening are all here representing the admin girls. We've also got Elliot Watson, one of our advisors in the back corner of the room, along with Matt McCabe down here. We've got Brad Abbott sitting next to him, also a support to our advisor team. Daniel Brown over here, one of the partners and one of the senior advisors in the team as well. We've got Adam Hoskins at the back of the room, who heads up our accounting SMS division, and Dustin Kavanagh, who has a new title, so bear with me, Head of Transformation. Maybe some of you can have a chat to him later on to work out what that is. Okay, so I just want to give you a bit of a rundown on this evening and how it's going to operate. We have three very skilled, very interesting speakers to join us this evening. We're going to start with a 20-minute session from each of them to come up here and to present on various areas within property for you. When that's finished, we'll actually invite Jess, who I've just neglected to... Jess, please stand up. Who's actually organised this evening? Have I missed anybody else? I'm so sorry. Sorry, Jess, I didn't know. So Jess is actually going to come up and moderate this evening with the three speakers, hence the couch part of the night. So that will take place a little bit later. Look, I just want to let you know we are on a somewhat tight schedule, and so I have brought along my bell, which you will hear ring occasionally. It's just a little bit of an indication for those speaking this evening that their time is coming to a close. I use it very effectively at home too, so it helps. Anyone needs to use the bathrooms, they are just outside to the left as you walk out, ladies and gents. Please feel free, if you need to go, please just, don't wait for the break. There's only one short break just during the evening. So we also, on the tables, there are feedback forms. I really encourage everybody to complete those for us. It's our only way to find out what's important to those that are here this evening and what would interest you to come back again and join us on another night on the couch. As an incentive, we have a $250 Jay's travel voucher that will be picked at the end of the night to the lucky winner who completes those forms for us. No more needed to be said other than to introduce our very first speaker this evening, Wayne Stewart, if you would like to head towards the stage. Wayne is the Managing Director and the Office Principal at Century 21 Newcastle. Wayne has been in the property industry for 37 years and has a wealth of experience, and he's going to share some of that this evening with us, both with the residential sales and project marketing. He has a formal education in architecture and construction. In 2005, he joined the board of Real Estate Institute of New South Wales and was voted to president by his peers from 2009 to 2011. Wayne will be sharing the pros and cons of purchasing property off the plan. Thank you, Wayne.
We're here tonight to talk about property. Mark and Ty and myself, we're going to give a balanced view of I'm going to talk about off the plan sales in Newcastle. Mark's going to talk about existing property, and Ty's going to talk a bit about commercial. So there'll be plenty of time for questions and that afterwards. But certainly, if there's anything you want to ask a question about along the way, just please put your hand up. Now, off the plan sales, I mean, I suppose at the moment we're seeing this bit of a boom happening in Newcastle. From an agent's point of view, we see this window of opportunity happening about every 10 years or so. There's a lot of good things happening in Newcastle, and I mean, we've all heard about the infrastructure spend through the state government at the moment. So all eyes is on Newcastle, and look, Newcastle has been, and the Hunter in a general, has been a place that, from an investment point of view, the country has had its eyes on for a lot of years now, probably a good 10 years. So, and I think probably the strength of the place here is that not only are we a very diverse marketplace as far as employment goes, because everybody thinks about the Hunter and coal, but coal probably sits as far as the Newcastle, that goes down around number 4 or 5 or something. But I mean, we're a diverse marketplace, but the most important thing from a Newcastle point of view and the good lifestyle is that we're still very affordable. And that's why I think a lot of people and a lot of eyes are on Newcastle and the Hunter. Now, I'm just going to talk tonight a bit about buying off the plan. There's a lot of apartments going up around Newcastle and the inner suburbs, and people get concerned at you know, what the truth is about whether buying off the plan is a good thing or a bad thing. And people say, you know, is buying off the plan cheaper than buying something that's already built? In a lot of cases it possibly can be. It depends really on the developer's point of view, whether they need to get quick sales to get the job out of the ground. Really, real estate tends to sell for a price whatever the market dictates at the time, and really the market does dictate the price of real estate across the board. So the good thing about buying off the plan is that it does give you a bit of time to breathe. So when you're buying off the plan, most of the time, with most of the sales happening around Newcastle, is that you'll talk to an agent, and the developer has got a set of plans where you can look at a design, and you buy today, and you're going to probably move in or gain title to that property somewhere between 12 and 24 months down the track. So the good thing about buying off the plan is it does give you time to breathe. If you're an owner-occupier purchasing off the plan, you've got that added advantage of being able to put all your affairs in place before you actually have to pay your full settlement fee for it. So shopping around for the best mortgage, I mean, you've got a plethora of mortgage opportunities out there in the marketplace today, so you've got that opportunity to be able to shop around for a mortgage. The other thing is coordinating the sale of an existing place. If you're an owner-occupier, for instance, a lot of the time you may be moving from an existing property, coming into the city for the city lifestyle and getting rid of mowing lawns and all that sort of stuff, but you probably need to be able to sell your existing property to be able to finally purchase the property. So buying off the plan does give you that time to be able to look around, make sure that you've got your property in order, get some indication from the agents and professionals in the marketplace as to what your property is truly worth, and look at the best way of presenting your property to the market. So that's probably a good thing, is saving time. I often get asked, over the last few years we've been talking about the fact that there's a housing crisis throughout Australia, and there certainly has been. I mean, the biggest problem over the last 10 years is that we just haven't been building enough housing across Australia to be able to suffice with the current marketplace, and that's really what's been pushing the price of real estate up. So, you know, we're probably seeing a lot of job starts both in the residential home sales. We haven't seen construction starts like this for probably a good 7 or 8 years, and of course with all the new apartments going through the city, we'll probably see that the housing crisis is certainly not as bad as what it has been over the last 10 years. Now, the other thing about buying off the plan is the ability to be able to capitalise on capital growth. So, you know, when you buy today, especially in a market as we've seen over the last few days, you're buying at today's prices, but you're settling at tomorrow's prices. So off the plan sales, as we said, we're looking at 18 to 24 months. Most of the time you're only paying a minimum deposit of say 10%. Most contracts provide for a 10% deposit, or a similar amount in a bank guarantee or a deposit bond. And then you're able to keep your money either tied up in your existing real estate or in the bank until settlement. So that's one of the other benefits about that, is you are incurring that capital growth which may occur on the property. Many developers also offer discount prices, as I mentioned a little earlier. So to be able to get a lot of these jobs out of the ground where they're being financed externally, the developers need to be able to sell anything from 50 to 70% of the properties off the plan before they can actually get a lot of these jobs out of the ground. So a lot of developers will, in the very early stages, just to get that initial spurt of sales and get the market moving, will offer some discounted prices to get you in there. So, I mean, if you're able to take advantage of that, you don't see it happen too often, but if you're able to take advantage of that, well, that's an extra benefit of buying off the plan, because you tend to find that even by the time the jobs come to a situation where most of the properties are sold, the properties are actually reselling for more than what you've paid for it. So there's a good opportunity there for capital growth. It also gives you time to save, and at the end of the day, less time to borrow. I know I've got one of my young fellas at the moment that's buying an off-the-plan property, and one of the good things about it, knowing what he earns, he's been a terrible saver up until now, as we tend to be when we're young. But the fact that he's actually committed now and put a deposit down on a property, he knows now what he's going to be able to save, and he was so proud that in 1 month he's been able to save $5,000, which is more than he's saved in his whole life. But I think the fact that you're able to make a commitment and work towards the end of knowing what you need for settlement, you can either make sure that you're saving more to lessen the amount that you need to borrow at the end, or you're able to probably save, if you are moving in, you might be saving for the furnishings, or saving equity for some other reason with the property. So it does give you that ability to be able to save more. And knowing that you put deposit down in exchange gives you that time to save for the furnishings and anything else that you may need for along the way, curtains, blinds, all those things that go with remodelling or bringing the apartment up to date. Of course, the government incentives, the first and second home buyers, which has changed a little bit over the last few years. The first homeowners grant for first home buyers, the scheme has changed a little bit and will change again in the near future. It's currently sitting at $15,000 if you're a first home buyer. It will reduce to $10,000 on the 1st of January in 2016, and that's up to properties of $750,000. Stamp duty exemption for first home buyers on homes is up to $550,000, and there's concessions from $550,000 through to $650,000. So it tapers down between $550,000 and $650,000. That can provide for a first home buyer, can provide up to $35,000 worth of incentive for a first home, which there'll be many of you here who sort of wish that they had those sort of incentives when we bought our first home. So it is a great incentive, and I think that's why a lot of first home buyers these days are looking at new homes if they can afford a new home, or they're certainly looking at apartments. And I've seen it in Sydney over the last 20 years. I've seen a lot of young people who, especially are working in Sydney, that make their choice to actually buy an apartment rather than a home. And I think you'll start seeing that a lot in the Hunter now, that a lot of young professionals will choose to make their first home in an apartment rather than a home with a backyard, for a lot of reasons, none more so than the fact that there's some great government incentives for it. The new home grant, also for anybody buying a property, a new property or a property off the plan, is still at $5,000 for purchase of a new home or unit, and that's up to $650,000 as well. So my girls put a couple of little cartoons in there, so I don't know if you guys can read that. I barely can read that. So. Depreciation. Now, depreciation's not a dirty word. I mean, a lot of people, when we're talking real estate, think that depreciation's a dirty word, and the properties are there to appreciate. But certainly if you're an investor, the taxation benefits through depreciation there are enormous. And once again, buying off a plan, the newer the property is, the better the depreciations are. So as with all investment properties, there are some significant tax benefits. These benefits are greater when the property is newer because of the tax depreciations that are available. Okay, so the depreciations vary. For the building, you're looking at about over a 20-year period, so about 2.5% a year. But then you've got different periods of depreciation depending on the cost of the product that you're buying, whether you're buying curtains and bits and pieces for the property that you can also depreciate. So you talk to your financial advisor for all those sorts of things. But certainly the maximum benefits are there when the apartments are new. So the apartments provide a greater appreciation advantage than a new home, as the percentage of construction per site area is greater. So when we're talking about, you might be looking at buying a new house and land package in a suburban estate, the depreciation on an apartment building is greater because the size of the building on the apartment is greater on the site area than it is for a house and land, which is common sense. There's also other things such as your lifts and your common area and plant and all that you've got depreciation on as well. So the other thing about buying off the plan is that you've got more choice. So if you're able to get in early enough in a development, you've got the ability of being able to choose which level you want to be on. Obviously, budget will come into that. Whether you want 1, 2, 3 bedrooms, whether you want to face north, south, east or west, and if in some circumstances there may even be a colour selection. So obviously you've got that benefit the earlier you get in on off the plan purchase of being able to choose a lot of the things that go with that particular development. Normally you wouldn't get that opportunity if you're buying something that's in the existing marketplace, and you're probably not going to get that opportunity as the building sales get towards the end. So you do have to be quick to be able to get that choice. And obviously a wide range of choice means the ability to be able to make sure that you do get that superior position aspect and floor layout, okay, which is important in a particular building if you're looking at making sure that you get your maximum capital growth in that within a particular development within the city. We've still got a lot of people looking for land. Land's an acute shortage throughout the whole region at the moment, and there is a bit of a boom on with new housing. Building the apartments, we'll talk a little bit about new homes versus apartments and the advantage of that in a moment, but once again, buying land off the plan, which you tend to have to do at the moment. I mean, if you are buying land because land is selling faster than it's being developed at the moment, I know with a couple of our developments where we're a stage ahead of ourselves at the moment, so if you are buying, you virtually have to buy off the plan, and you have to be prepared to be able to wait 12 months for the land to register. So the only caution in that is you'll shop around for the builders. The good thing is you get a choice of thousands of different builders and designs out there to be able to choose from when building your home. The builders will, if you're buying off the plan land, will try to talk you into dealing with them sooner than later. You just got to look at the tender time. So they'll go and give you a price to build on that respective block of land. A lot of the time that tender will only last 90 days. So it's important if you're buying land off the plan and then you're going to pay a deposit for the construction of a new home on that particular block of land, that you look at the tender time, how long that is. I know there are quite a few builders out there that are offering 12-month tenders, which is sensational, because a lot of the time with off the plan sales on land, especially with the elements, you can wait up to 12 months for that land to be registered, and unfortunately if it's not registered by the time the tender ends, well, there's a good chance you're going to end up with a price that's rising with the builder, so keep that in mind. So as I said there, you've got thousands of home designs and sizes and facades which will suit budgets, so it doesn't matter which budget you're looking at, you'll usually find if you're buying a house and land that there's going to be an opportunity there. The most important thing when you're buying something from an investment point of view, and look, it's whether you're buying your first home, I always say to young people buying their first home, this is probably one of the most important investments that you'll ever make in real estate. So it's important that whether you're buying something for yourself or buying something for investment, that you look at it as an investment property, because they're all investment properties. So look at the location that's in the respective area that you're looking at. Look at the infrastructure and the potential spend on infrastructure. Maybe do some research. There's some great websites out there to look at the investment potential of particular areas that are out there. Talk to the local real estate agents about what's happening in that particular area, especially with infrastructure and maybe proposed new amenity, and what transport and what growth is there. So that's all important for there. And of course the risk. You look at the other side of what are the risks of building in that area. Is it an area that's dependent? If we look at areas such as the Upper Hunter at the moment, where they were probably very dependent on the mining industry, there's a bit of devastation up there. So if you're going to look at an area for buying in from an investment point of view, it's good to look at an area that's got some balance in it, so that it's not dependent on one particular industry or something in the market that can go wrong. look at the rental potential, employment growth and the potential capital growth and the availability of future land, because obviously if you're buying into an area where there's thousands of land releases, it's going to stifle your growth in those areas. We talked about apartments versus new homes. Not only are off the plan apartments usually more affordable than houses, but they're more likely to provide higher rental returns, body corporate building management, closer proximity to the amenities such as employment hubs and transport and shops. They make it more attractive to tenants for those same reasons. The vacancy rates on apartments are usually lower, and it's usually better security as an outcome. It wouldn't be right if I didn't look at the other side of the equation from a balance point of view. So the disadvantages of buying is that, especially if you're an owner-occupier, is you can't move in immediately. It probably doesn't matter to those that are investors, but you can't move into the apartment. You've got to wait up to your 24 months. We could be in a situation like we were in 2008 where the market went the other way. It doesn't happen very often, especially here in Newcastle, and probably Newcastle, when compared to the rest of the country, probably was one of the better performing areas throughout the GFC than any other location. But certainly if you looked at the top end of the market, certainly up around the apartments that were around that $1 million mark during the GFC, there was a bit of value wiped off them, which took a few years to recover. So once again, if you were financing before then, and you may have found that the valuations on that top end of the market may be less when you actually finished than when you actually bought off the plan. The development may not go ahead. So it once again doesn't happen too much down here, but you do hear stories of people paying deposits and it not going ahead. Certainly if it's a situation where a developer who needs that 60 to 70% off the plan sales, if he can't raise those sort of sales, he may decide to shelve the development. It may not be as good, the grant incentive, as it looked off the plan, and the situations can change, such as children, marriage, divorce, all that can change your motivation. Tips for buying off the plan: health check your financial position now and for the future. Look at the median prices for similar properties in that area. This is all important research to do. Research the track record of the project team, the architect, the builder and the agent that's selling it. Track the settlement date throughout construction. So if you've got a good development team and an agent there, you'll tend to find they'll keep in track through a newsletter or something like that. And lastly, but more importantly, research the track record of the developer. Judge the investment first and not the tax benefit. So a good investment must be profitable over time in this respect. It shouldn't and it should give you steady income throughout the project. So whilst this income will incur some tax, it's important that you consider a prospective purchase from its total investment value and not the taxation benefits. So things such as negative gearing and depreciation are certainly great there and it'll help reduce your tax. But unless the investment is a performing investment, there's not much benefit in really being in it. So there's no point in having negative gearing without the capital growth. So that's very important. And that's about it from me, guys.
Okay, I'd like to introduce our second speaker this evening, Mark Cantwell. Mark is the Managing Director and the Licensed Agent of PRD Newcastle and Lake Macquarie. Mark is PRD's #1 selling principal nationally and has been ranked number 15 in Australia across all brands by Real Estate Business Magazine. Mark also has sold more homes at auction than any other agent in Newcastle, Lake Macquarie or the Hunter Valley in the last 5 years. In addition, Mark is a real estate speaker and has also appeared on Selling Houses Australia and House Hunters International. Just this week, Mark also took out the Regional Principal of the Year award. So without further ado, Mark is here this evening to present the pros and cons of buying and owning traditional established property from his perspective. Thanks.
Thanks, Kate. I'm here to really talk about existing property, and Newcastle has a high percentage of existing property because, we're the second oldest county in New South Wales. So, and people are quite used to transacting existing property, so most of us here will live in a property that's already been built and been up for some time. And there's more than one form of investment when it comes to property, so I'll explain that as we go as well. I've just got a series of headings to talk on here. You may wish to take some notes or to touch base a little bit later about some of the topics that I speak on. I aim to keep it pretty concise and on time. One of the benefits of existing property, and especially the one that you live in, is that your home that you live in can be a form of investment. And what I mean by that is that if your house and land is appreciating over time, then you're actually making money off that investment, or you're building an equity base. So there is a major advantage to that live-in investment that you've got right there. You can add value on the way through, and I'll explain how you can add value on the way through to the home that you actually live in. And one of the fundamental things that governs how property actually goes up in value, which I've just noted here, is that it's actually supply and demand. So it's supply and demand that drives the price of property up over time. Population growth is a factor. The fact that they're not building any more land, you can build more building, but it's hard to build more land unless you actually go out into the ocean like they did over there in Dubai and Oman and areas like that. But essentially, we just have a fixed amount of land. So if you've got a large portion of that land, it's actually the land that goes up in value, and it's the building that goes down. And like Wayne said, depreciation is not an evil thing, and there's some tax advantages that can be had from it. But it means that over time, that bricks and mortar will start depreciating, becoming older, needing maintenance, whereas that land becomes more and more valuable over time. If you look at the last 10 cycles that have happened in Newcastle, we've got an excellent growth curve. It basically goes up when the market goes up, it pulls back just a tiny bit, and then it goes flat for a while, and then we go up again. We don't have those massive peaks and troughs and sawtooths that a lot of the other markets around the world, and even in Australia, tend to have. It's a nice steady curve. We do tend to lag what Sydney does as far as the marketplace goes, but Newcastle's starting to forge its own identity as a real estate market. And not only there's the supply and demand that drive prices, but there's other economic drivers on top of that, and there's market drivers on top of that, which I'll touch on in a minute. The good thing about existing property is that there's a lot clearer 4 ways that you can build equity in that property, whether it's an investment, well, I'll refer to it from an investment point of view at the moment. So let's just say we go and buy a little house in Maryville. It's on 350 square metres. Now, most of you will know where Maryville is, but it's in what I call the inner northern suburbs. So it's just over to the north there as you're heading out Hamill Street. It's in that what we call the Throsby Basin there. There's sort of 5 little villages amongst that. And very highly sought after at the moment. It's sort of thriving from the Honeysuckle precinct. The Wickham train station is going in there, all the changes with the light rail and the big interchange hub. It's got that villagey atmosphere. It's very close to Hamilton as well and close to the harbour. If you were to buy a little cottage in there, let's say it's an old 3-bedroom home, or it's a 2-bedroom home that could be improved because of the land size, you can add value to that property that is higher than the amount of money you spend on it by doing an extension or renovation on that subject to it going through DA, a council. If you're doing it within the walls, there is an advantage though, because a lot of the time, if you're not doing anything significant to the structure, you can add value to it by just cosmetic style renovations that you see a lot of on The Block and the Renovators and other shows like that that have created hordes of buyers out there at the moment looking in the market. Another way that you can add value to that existing piece of real estate is to help the rent come up in value. So with apartments, for example, you've got a number of apartments in that block, and the rents are quite heavily governed by what the other apartments are getting within that block, because they're all so similar. Now that does change per floor, like Wayne's saying, and with aspects, but essentially bedroom, bathroom, car, and the square meterage of that will heavily govern what rents are going for in that building, and the tenants get chatting, and the property managers seem to know what's going on in there, and a lot of that information is readily available. With houses, it's quite easy to make one stand out from another. There's a number of items that you can do to a house to improve the rent for that individual that's there. You could put blinds out the front to stop the westerly sun coming in. You could add an air conditioner to it. You could polish the floors, put a dishwasher in it. Lots of these little things that you can do. Or you can actually do a renovation to the property. And it depends how far you go with that renovation as to whether there's a tax advantage to the work that you're doing there or not. But basically, if you improve the rent of that property, it does have an intrinsic link to the actual value of that investment. Because if a property is returning a certain amount, it's going to be more appealing to another investor in the marketplace, and then you can ask more money for that should you wish to cash it in. And banks and valuers will also assess that when they go to check on what your equity is in that investment. There's organic capital growth as an advantage as well, and with all types of property it's out there. But the organic capital growth is one way that you can pick up value within an investment of an existing property. And I'll touch on this a little bit more when we talk about how we pick a good investment, or how we pick a good home to live in that will have an investment potential or a capital growth potential. But essentially, supply and demand comes back to it. If you're looking at a small suburb, and I'll take Cooks Hill for example, there's only about 1,000 homes in Cooks Hill. But I reckon I'd have 1,000 buyers for the homes in Cooks Hill at the present time on our database. And the thing is, and Wayne probably would have a lot of them as well, and the other agents would as well. and there's only a limited number of transactions that go through that market. In fact, 55 Torrens Toll houses only selling Cooks Hill per year, because not everyone's offering their properties up to the market at any given time. So when you've got 1,000 buyers trying to buy 55 homes in a year, and you divide that 55 homes up by the 12 months that's available, at any given time there's only 5 homes on the market, and there's 1,000 buyers trying to buy 5 homes. So where do you think that's going to push prices? In an upward direction. And that's why a suburb like Cooks Hill, and I'm not saying just by Cooks Hill, but that's an example, if you look at that kind of equation, that over time it's continued to perform, even if the Sydney market's declining, or they're talking about bad interest rates, or they're talking about a GFC, there's still only 1,000 homes, there's still only 60 sales a year, and there's still lots of people that want to live there. So we'll have a look at what the drivers are at the moment for a suburb like that, or Maryville, or New Lambton, or whatever that might be, that helps that come up. The next thing is the ability to add value. When you've got a piece of land, there's the subdivision potential. So the subdivision can happen right away if you've got a big enough lot and it fits in under the current local environmental plan or under the council guidelines for that area. Or sometimes if you're lucky enough to have a property that is currently zoned a certain type of residential, for example, like residential, normal residential, which might be known as a 1 zoning, where it's just low density. And then they decide that that area is up and coming, there's more infrastructure going in, there's more schools, there's more residents moving in. We're now going to approve that as a higher density or a medium density area, and that might make the land value worth quite a bit more because your block is now double the size of what they're happy to have a block. So you can carve a block off yours and either sell that, build another property on it, or it's just worth more as a piece of land because it is subdividable. So you can just be holding a property and doing nothing to it. And over time, as the marketplace changes, you've got some advantages that come from that. And when there's land involved, they're not building any more land. So that is one of the advantages in there, which are the main things I'm talking about at the moment, disadvantages. So how do we pick a growth area to live in? So I came back before how that the house that you live in can actually be an investment. And when I say an investment, it's just building an equity base. One of the major advantages about your own home in Australia is it's one of the very few capital gains tax-free investments that you can have. Tax-free. It's a real buzzword in a room like this, tax-free. It's what? Yeah, right? So it's quarantined. And there's some pretty loose rules around it, but basically if you live in a home for 5 years and it doubles in value and you move out, and you make $300,000 or $400,000 after your mortgage has been paid out, that's your 400 grand. It's like winning prize money. And they can't tax it. And the advantage of that is when you think about it, like let's just say an average, let's just say to use round numbers that you earn $100,000 and 40% of that gets taxed. It's kind of like you have to go and earn, you know, quite a bit more than that, you know, almost double, 180 grand just to get that 100 grand. Whereas if you make 100 on your property, you get the whole 100. Okay, so there are some advantages to picking the right place to live in. And I've got some clients that have sold 6, 7, 8 properties with me over the last decade that have you know, moved into one, done their little bits and pieces over time. Some of them have done hardly anything to the property, they've just bought well and been shopping in the market. Some of them have renovated, really aesthetically pleasing. Some of them have done substantial renovations that have required DA approval, or just fitted out with new kitchens, bathrooms, all the stuff you see on the TV shows. And they've made massive capital gains on those properties and then just moved in and done it again. And I've got one particular set of clients which I refer to at the moment. They're basically living more than half of their life overseas now, basically permanent holiday. They come over, they do a little reno, and they sell it, get great money for it, go on to another project, put some tenants in it while they go, come back, do it all again. And they've just been making so much money over time, and with smart investment, so it's not an automatic guarantee, but they've done it well, and now they're at the point where they've held a couple of properties. They've put tenants in those properties and they're cash flow positive now. So they're earning enough income for them to be overseas spending their money, plus the big nest egg that they've got from the properties that they've transacted. So how do we pick a good growth area to actually live in? Well, that first part of it's going to come in, do you want to live there? Because that's going to be a big criteria. But a lot of the time, there's 4 or 5 places, if you really look at it, they've got a lot of the things that you want. There's things that drive the market, and we've got to look at that whole, let's look at the macro market to start with in Newcastle. So I'm not saying the whole of Australia's market, but let's look at Newcastle. What have we got going on in the inner city right now? Like Wayne said, public infrastructure spend. That is a massive driver for growth. So we've got a $340 million light rail, which will probably blow out to more than that. But they say that when you spend $1 from the public sector, the private sector invests $2 into that area. So if you've got a $350 million spend going into an area, that's actually $1 billion going into the area. When $1 billion goes into the area, there's actually more stuff to do and enjoy. So more people want to go there. From a tourist point of view, they want to live there, the rates go up, the council can afford to spend more money on the area, it becomes even better to be around that area, and all of a sudden, the values go with it. But it doesn't just happen in the CBD with the light rail list, it happens and it emanates out. If you imagine a circus tent, you've got the point in the middle and then you've got it drifting out afterwards. So you might have people that used to live in the city, got a bit too hectic for them, sold up for big bucks, bought 2 suburbs over, now you've got a new area of settlers there that are happily investing in their properties, renovating. Those areas are coming up in value too. What are other things to look for in those areas? Well, actually, I'll keep going on the investment for a moment. Education is a massive driver of growth. Now, our university out there at Callaghan, at Newcastle campus out there, they've just been ranked number 28 in the world under 50 years old. Okay, that's a big deal. And I know the Asian market, for example, is watching Newcastle very closely as a result of that, because if you think about that kind of credibility there, where a lot of the new universities are in places like China and Europe, and we're number 28 in the world, they want to be near good education. But on top of that, there's a $100 million campus being built right now on the corner of Auckland and Hunter Street. Now that's going to bring, as everyone keeps saying in the paper, about 3,500 students to the city. Now those 3,500 students are predominantly studying business and law, because that's the faculties that will be in there. So their parents are most likely to be business or lawyers or international students, some form of subsidies as well. So a lot of them are prepared to pay good rents. Now that's going to push the rental prices up in the CBD, but not everyone wants to live in the CBD, so the rental prices emanate out as well. Some people prefer to have a yard for their dog, things like that. So you've got to have a look at what are we close to that's going on that's a big advantage at the moment. And there's other things happening in town too, like the courthouse precinct, the GPT mall, all that sort of stuff. That's right in town. What do you look for in the suburb itself? Well, schooling is a big one. Like I said, education, how people like to invest around education. There's schools around town, and those of you that have got kids, especially those at primary school age, will know what the good schools are. And I won't go through each of them because it might be a bit biased and you might say, no, my school's better, or you might even be a teacher at those schools. But there's certain schools that have got great reputations, and that helps property prices. Because imagine a suburb, again, when there's only 30 or 50 homes coming through per 1,000, and there's only a certain amount of homes that are going to be available either at the end of the year before the school starts or at the start of the year when school starts, that's going to push people in the northward direction trying to buy into that area, or even the rents. People want to move in, rent for a while before they buy there. So we're going to look at the drivers, and are there multiple drivers for that area as well. Like to also look at, okay, if you were to move out of your house, would there be a tenant for it? So is it an easily consumable product from a rental point of view, or is it way over the median and you're not really going to get a lot of rent for that property? Another thing to look for when you're having a look at what area to live in, what's happened near you. So let's just say, and I'll pick Islington as an example, Hamilton's already gone up a lot in value. Centre in Newcastle's already gone up a lot in value. Islington, for example, is the next one over. So you see about half the homes in Islington right now are renovated. The other half are still there to be bought at the current market rate, but once they all become renovated, all of a sudden the demographics have lifted, you've got the rents coming up as well, and you've got an area that's very desirable to live in. The investment goes very close to what we're talking about with actually a place to live in. But we've got to look at a couple other factors too. If you're going to buy into a property and you want to renovate that place, not just from an area point of view, but how much can you spend on the renovation? Have you really done your numbers right down to the bottom ground? And if it's going to be one of your first investment properties that you buy and you want to do a renovation to that place, you've got to consider what budget have I got to do the renovation and how aggressive do I want to be on the style of renovation. I would urge those who haven't bought a renovator style property yet to buy one that doesn't require an extension or a DA approval for the work. Do a cosmetic only renovation. Get something with a good grounding, with good piers. It's not going to crack too much when you move it around. Floor levels are intact, and just change kitchens, bathrooms, maybe a couple of internal walls. Not too much as far as engineering goes. Maybe a big room that's got an extra living space you could repurpose into another bedroom, create a bit more capital growth that way. We're still on the renovation theme here. DAs in council can take some time, so you've got to be prepared to hold on to that property and what you're going to rent for while you hold it. I'm a big fan of when you buy, and your investment advisor can tell you which way you go, but I'm a big fan of 20% deposit in for an investment as opposed to 10 or 5. There is great leverage with 5 or 10, and you can buy more properties, but you've got mortgage insurance to consider, and you're a bit more fragile to market fluctuations if the rents go down, if it doesn't rent for a while, or if the market actually goes down as well, and you can all of a sudden be in negative equity. So when you've got 20% in, it's pretty hard for the rent not to cover the amount of interest that you've got to worry about. Okay, a couple of things on how we sell a property for more when the time comes. So think about 5 Ps, and I'll add a 6th one on there. The first one is the property itself. So the actual bricks and mortar that's sitting on that piece of land, that's got a part of the value there. How you've done that building, the architecture of it, the look and feel from the street. The second one is the position of it, not actually put it to you that that's the highest value part of the whole equation. The third one is the presentation. So if we're going to market, we need to make sure the presentation is A1. And there's that many tips out there on doing it now, but I'm a big fan of getting someone in to help you do a makeover before it goes on the market and realise all the value that's there. Then the things that we can control once we're on the market are the promotion and the price. So if you get the proper campaign out there and you've got the right price guide on it, you should have competition on the property. The last thing I'll focus on is another P, and that's process. And that's a big job for the agent to recommend the right process for you. There's a million different agents out there, and there's a great variance in the fees that they charge as well. But there's an even greater variance in the price that you get for the property if it's done correctly versus if it's done in a shortcut fashion. So have a think about that if you do go down that path. Of course, we'd be more than happy to talk to you if you need any advice on that. So the last thing is about Newcastle, what's happening now. Well, I've touched on some of those key drivers. And whether it's a residential investment where you're buying a house and a piece of real estate there that you can actually improve or change yourself, or you're buying off the plan, my outlook is that Newcastle's got an incredible decade ahead of it. Now, that doesn't mean year-on-year growth for a decade, but it does mean that we've got multiple drivers. When you look at other areas around the country that have gone up over time, I don't think that there's too many that have had as many drivers as us. We've got tourism, and that's increasing with the sale of the port and the cruise ships. We've got beautiful beaches, which attracts more people. We're quicker to get to the valley now with the expressway. The airport's being upgraded, as well as the transport to and from the airport for the business community and the tourism community. We've got massive public infrastructure spend going on in the CBD. And you've got confidence, you've got business. There's so many things to offer with Newcastle at the moment. If you want to get a bit more information about that inner city vibe, what's happening around Newcastle, you can pop into our display suite, Newcastle New Projects in the mall, and we'll give you a rundown. Thanks very much. 20 minutes.
I'd like to welcome to the stage now our final speaker for this evening, Ty Bland. She's the principal of LG Hillwood Commercial on the Central Coast. He's in the room. Ty has a Bachelor of Business in Property Economics and a Diploma of Management, and is a member of the Australian Property Institute. He is a presenter for the commercial property segment on 2GO Real Estate Show on a regular basis, and he also has written several specific articles for Sold magazine and the Central Coast Business Review. This evening, Ty is here to speak about, he's specialising in the commercial, industrial and retail property sales and leasing, and will be sharing his experience in this area with us this evening. Thank you.
This image I selected because it represents to me the Central Coast commercial market, and in fact the commercial markets in a lot of the country at the moment. The Lotus, typically in Indian and Asian sort of culture, a lot of people don't know this. I've been in that sort of environment for a long time and I didn't know it until recently, but it represents the beauty that comes from mud and water. So when you see a lotus or a Buddha sitting on a lotus, that's because all the bad stuff and all the mud and all the horrible stuff actually brought him to fruition, and it's the same with these markets. So in these markets on the Central Coast, what I'm going to go through is basically an overview that will help you to develop an understanding of what's been happening over the years and as a result of the global financial crisis. We will look at the commercial property market on the Central Coast by dividing it into market segments, and we will discuss the shifting demand patterns. Essentially, what I want to do is provide an overview on sales composition by volume in each market segment, because it shows you what's happening there at the moment. And it's a reflection pretty much of what's happening in Newcastle and the Hunter as well, and also in parts of Sydney, most of Western Sydney certainly. By contrasting activity and sales volume in the local commercial market, it gives you a good idea of what's happening. And we'll go through this in a little bit of time with the graphs that I've got here, but essentially the graph that shows how many sales and the graph that shows the volume by dollars of sales and how they interact and change, that's very important to give you that understanding. We'll also contrast the current value ranges with ranges over the past few years, which is different, and we'll provide a commentary on the opportunities resulting from disparity and the inequities in the broader marketplaces. It's those things, and that's basically what Mark was just talking about and basically focusing on, that help you to buy property very well. So with commercial property, the best thing to look for is also location, but the drivers for location are completely different to residential. Basically the market for strata title industrial, retail and office is what's known as the commercial property market. So comprising small factory bays, often including an office portion and amenities block, those sizes between 150 and 500 square metres are what we call small industrial, and that's probably the biggest turnover on the Central Coast. Comprising the older style of retail, that's the development of small shops that you see, strip shops here and there. That basically is the regional style of retail, and that market's very different to the retail that you see in areas such as Westfield or larger shopping centres. The larger industrial, which is comprising small, medium and large manufacturing, but more on Torrens title lots, that's a totally different market to industrial that's strata title. And the office space, which comprises older title in traditional CBDs, Gosford and Wyong, we're going to talk about that in a sec, through to more modern precincts such as Erina and Tuggerah. Those office drivers are very different in each location. So if you have a look at this chart, just quickly, we'll go through this in a bit more detail, but you can see, for example, that the industrial strata has changed between 2007 and 2009. There's also a slight change in the industrial vacant land, but it's not that significant, and the bigger industrial properties has changed quite significantly, as well as the office retail sector. If you look at 2010 to 2013, industrial strata has stayed at about or over 50% of the market, which is pretty amazing. Office retail has shrunk a little bit between 2010 and 2013, but it's about the same size of the market. And the market segment for industrial Torrens, larger industrial, and industrial vacant land has stayed about the same. So my observations on that data, which has been provided for us by Robertson Valuers, who are very good to do it for me, suggests that a large increase in strata title industrial transactions has happened on a year-to-year basis. Declining capital values, predominantly due to distressed and over-anxious vendors, which has happened through the global financial crisis, with pressure being put on businesses for different reasons. And medium to large industrial premises have been severely impacted on by the GFC because of uncertainty and generally quiet economic activity. The office retail market segment has been reduced remarkably between 2007 and 2009, but it hasn't been affected as much as the other subsectors since 2009. The other thing that's happened is vacant industrial values for land and the development markets have slowed. And this is driven by, basically, the financial constraints. So with industrial land, you need to get pre-commits, the same as you do with a residential development. But it is industrial land that drives growth. So if you don't have new buildings coming out of the ground, prices can start to go up, and that's what's starting to happen now. Development sites and commercial industrial land values have been crippled. The reason that they've been crippled is because you can't go and borrow to buy land very easily now at all, without pre-commits, which are very, very difficult to get at the moment. Finance is more difficult to structure for development because of the fact the GFC restructured the way it looked at commercial property much, much more heavily and much more intensively than it did with residential. So you can still go and borrow to buy for a house quite easily, and you can borrow 80%, or if you want to pay for a bit of mortgage insurance, you can borrow up to 90 or 95%. But typically with commercial, you can't borrow more than about 70%, sometimes you can get 75, and a lot of the time it's around 50%, especially if it's going to be for a development that has no pre-commits, it'll probably be 30 to 40%. There are many opportunities in the marketplace and with self-managed super funds for this reason, and I'll explain this in a minute. If you have a look at this graph, it shows the red line, which is basically tracking to show sales activity, which is the number of sales, which is on the left, and the black line, which is total sales value, which is on the right-hand side. Originally, if you go back to 2004, you can see we were coming off a peak in 2003, where those sales numbers and total volume of sales were much higher. It intersected at a point at 2005, and then really it intersected again in about 2009, 2010, and traversed from one angle and one opposing aspect into the other. What that means is not just, okay, we went from 380 to 200 sales, but we also have about 250 to $275 million worth of sales per year that went up to almost $400 million worth of sales, 270, and then dropped back down. And it's intersected again, which basically shows that now the sales activity is again, as it was 10 years ago, higher than the volume of the number on the dollar number of the sale. Basically, this number here is the number that's showing how many millions of dollars of sales we've done on the Central Coast, and this red line is showing you the number of sales. That graph basically says over 10 years it's a terrible thing to invest in commercial property on the Central Coast. But where we are now is showing you that right now it's a fantastic time to invest in commercial property on the Central Coast, because we're at the bottom of that ebb, and it will certainly increase, in my opinion, over the next 5 to 10 years. And I'm not just saying that because I sell and lease commercial property. Let's analyse that a little bit more. 2003 saw that peak. We talked about that. At that time, speculative development was also riding on the crest of a strong economy, and the availability of finance was structured on the shoulders of residential property values and the equity that people had in their homes. Essentially, when you have equity in your home, you can go and do other things with it, as well as just sell the home and put the money in the bank or go overseas. So people go and buy factories, typically, when they have equity in their homes. If they don't have any equity, they probably don't have an equity base that will allow them to own commercial property. However, when I meet people at factories and I talk to them about selling it, oftentimes they're guys, we were talking about this before, that have a pair of stubbies and thongs on, and they walk out and say, yeah, I need to sell or lease this factory, and then after talking to them for half an hour you find out that they own 20 or 50 factories. So speculative development that happened during the strong economy, which is reflected in that graph, doesn't show people who held property through that time and who kept building it. Land prices and the cost of concrete and steel were much lower, so feasibilities could be done on the back of the coaster. And I used to meet guys and we'd go, yep, we can do this, bang. I'd sell them a block within, honest to God, within 28 days or 30 days, I'd sell the whole development, and I'd already sell them another block before they started turning dirt on that development. And then we did the same thing again and again. Because spec development back then, the banks would just go and take the money, keep going, keep doing what you're doing. As costs increased, so did capital values. Developers allowed prices on new stock to creep up, but without decreasing their margins. What's happened now is it's too expensive to go and buy land, particularly industrial land, because we're talking about most of the market on the Central Coast. So people can now go and buy land and develop only if they've got pre-commits, typically because the costs of concrete and steel, which make most of the buildings, have gone up so much. So there's just not very much of a margin in there. The 2010 year has relatively subdued sales activity compared with previous years, but it shows a higher number of sales in 2009. For the first time since 2004, sales activity is tracking on that opposing tangent. This suggests that there's been a disproportionately higher volume of lower value properties transacting over the 2010 year. And it's been the same pretty much since the global financial crisis started until now. There are some larger sales. I've just recently put a $10 million deal together with Cordina Chickens at North Wyong, and that's probably, you know, one of the larger design and constructs that's happened in the last 12 months on the Central Coast. But it was a bit lucky that we had them, because we had Sanitarium about to build on that block, and they changed their mind, and at the same time the developer came to me and said, oh, well, can you sell it with the DA plans? And I said, to find a food producing facility is probably going to be like 1 in 1,000. Luckily, within about 3 or 4 months we found one and put a deal together, which was great. If you have a look at the smaller units and the office units that have been built on the coast in the last 5 years, most of the development that has been built has been sold or leased quite successfully, but there's just not much happening compared to what was happening before. So that helps you to understand that at the peak and back then, what was happening was we were riding on the crest of a strong economy. People had equity in their homes going up, 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 up. So they had $200,000 worth of equity. They went to the bank and said, we want to buy a factory. They said, sure, we'll lend you $200,000 because they got the equity. And it just snowballed into a massive, boom, basically, for commercial property on the coast. Commercial demand patterns are shifting. Mum and dad purchasers do not have easy access to equity or finance for commercial property. Self-managed super funds are becoming more popular. It's a great vehicle, self-managed super, to purchase commercial property with, because when you buy commercial property, you can lease it to your business, so you can live in it. Whereas with residential property, you can't buy a residential property with your super and live in it, but you can do it with commercial property, which is a big thing, because you can set the rent, you can work out what you want to pay yourself rent within a range. It's got to be an honest range, but it can be at the higher end of the range. So you can buy a property for $800,000 and you can probably lease it to yourself for $100,000 a year. So you're paying yourself that money into your super fund, and at the same time what you're doing is de-risking your investment, because investment yields and things that have to do with return on commercial property are always a reflection of risk. So if you can de-risk it by putting yourself in as a tenant and you can still get 10% or 12% return, it's fantastic, and it's legal, totally legal. Self-managed super funds can also buy for investment and or owner occupation, as I said, and they're not easily structured for development, but that creates a vacuum for design and construct opportunities. So people who want to invest but not using their self-managed super fund, now's a good time, because self-managed super funds can't go and do developments, which means that developers that can just need to make sure that the location that they're doing it in and the returns are there. Shifting demand patterns, as we said, depleted stock, specific classes of commercial property assets. I did do an example which I'll quickly flick through. Highlights and opportunities, 2014 and beyond. It is land values that allow you to do things, and basically land values that are lower, that allow you to do higher and better uses, are essentially where you can make a lot of money in commercial property. So I can sell you land for $135 a metre that you can go up 6 stories on with commercial office space. If you try to buy that in Newcastle, it's probably cost you about $1,500 a metre. But it's just about picking the spot. That's in Tuggerah Business Park, which is a favourite of mine because that's where our office is. This premium grade office space, which there's just a couple of pictures there at Erina, you can see we're renting it for $400 a metre, selling it for $4,500 a metre. The land zoned for that, you'd probably buy for $905. That was a sale that I used, a metre. Looking at Tuggerah Business Park, you can rent for $220 a metre, sale for $2,500, probably to $3,500 a metre now too. But the land zone for that could be purchased, and was purchased in that case, for $85 a metre. So that's a big disparity, and that's what I'm saying. There's a lot of things like that I can't go through in the next sort of minute and a half, but there's a lot of disparities on the Central Coast that will allow people to get, really good investment. That's just a quick overview of prices for you to have a quick look at a glance at. It's showing industrial sale rates, industrial rents, commercial office sales, commercial office rents. bulky goods sales and also bulky good rents. There are areas obviously that don't have bulky good facilities in them, but there are predominantly only minor changes across some of those, and there are other disparities that are huge, like Erina, 2,500 for commercial office space, up to 5,500, whereas at Morisset you can probably get an office for 1,500 to 1,600 a metre. So that means people in the marketplace obviously look at those locations and those premium locations and pay a premium. In conclusion, it's imperative that each opportunity is weighted carefully against the competition in the specific market segment, and that you are open to advice on specific points of difference. There are signs of improving market activity with very competitive values on the Central Coast, in the Central Coast market, and that's what I've used. It's just, rather than do Newcastle, that's what I know, so that's what I've decided to talk to you about tonight. There are larger companies relocating to the coast from Sydney because of lower rents, greater logistic opportunities and the geographic position between Australia. Two biggest markets, you've got basically 7 million people in Sydney and Newcastle, and we're right in the middle. Obviously for logistics, that's why people like Woolworths build 78,000 square metres, under roof for a massive distribution centre from there, because it's cost effective and they're close to those two markets. There are untapped opportunities with self-managed super funds looking for purpose-built developments, and having the right information is essential. Inequities and quality opportunities are lying dormant, definitely, for well-positioned developments in the next few years as well, which you probably won't be able to do with a self-managed super fund, but with investment funds you can do that to sell to self-managed super funds. That's it.
Personally, so I'm really excited for this session because, as most of you probably know and what we've heard this evening, there's so much activity happening right at our doorsteps at the moment, so I can't wait to sort of get it from the ground level of the coalface. And now most of these questions I've got this evening that I'll be presenting to the guys, you guys have actually given to us through your registration form, so I really appreciate that, thank you, and hopefully I can do them justice. Firstly, I think we'd like to start with some stuff around the local market. Mark, I might start with you. In the last 6 months or so, and from what you've told us, I believe property prices are going up, there's low stock levels in the market, lots of buyer demand, auction clearance rates are out of control. Now, what do these indicate for people in the market, buyers, sellers?
Yeah, so from a buyer's point of view, I suppose that you've generally got a bell curve when people are buying a property. So you've got, something equivalent to your innovators, and they're the first ones into a marketplace, and then you've got your early adopters, and then you've got your early majority, then your lagging majority, and then after that, you've got people who are generally resisting doing anything. It's definite that we're in the early majority stage now, where everyone's cottoning on to the fact that there's a lot happening in Newcastle, and I think there's a lot more potential for that, just because of those big macro drivers that I told you about. So from a buyer's point of view. From a seller's point of view, it's a great time to sell if you're looking to cash in. There's options there where you can build more equity by taking some out and going and buying another property as well. But there's certain markets that have had a really good, strong stint of growth. Those particular suburbs are unlikely to have the same amount of growth in the years to come because they've had a spurt. So there's a lot to be said for people who trade property and grabbing the big gain while the sharp part of the curve is there, and then going and buying into another preeminent market. So that's the sort of opportunity out there for both parties at the moment.
Great. Now we've touched on a fair bit this evening around the CBD and all the development and stuff that's happening there at the moment. There is a bit of concern that possibly we might see oversupply in the future. I'm not sure how far down the track. Wayne, what can you say to that? I know you work a lot on the developments coming up in the CBD.
Yeah, look, that's a question that I probably get asked on a daily basis at the moment with the amount of prospective apartments that are in the newspaper. I think first of all, what gets reported as might happen and proposal doesn't always end up happening. I mean, if we go back to 10 years to when the last major window of opportunity was there, probably about 30% of the stock that was proposed and even DA approved, there was an awful lot of DA approved apartments that still haven't come out of the ground. They probably never will because they're probably not viable anymore. So first of all, probably all that stock won't come out of the ground. I think we're in a very different marketplace now than we've ever seen in Newcastle. As Mark touched on, a lot of the infrastructure will change the way that Newcastle will be forever. More than ever we're seeing, such as Sydney has seen for the last 20 years, people that really want to live and work in the city. They're choosing the option of giving away backyards. So I think you're going to find that there'll be a greater percentage of people wanting to come and live in the city than we've ever seen. We've got more people than I've ever seen in my 36 odd years of being in property wanting to invest in property in the city. So the depth of the market is certainly a lot bigger than I have ever seen in history. And look, the city is getting better. So as the city improves, as Mark touched on before, it'll compound and more people will want to come to the city.
So we're talking about all this extra stock coming on the market, but I mean, what sort of stock is it? We're looking at studios for the uni students coming in. Is there actually opportunities for people to residentially own occupiers, buy and move in there as well?
Yeah, so there's a large percentage right now. The flavour of the month right now is studios and one-bedders, because there's such an appetite for it. It's very readily consumable by the market, and a very sweet spot in the market. It works well with things like self-managed super fund, first-time investors with all their incentives that they've got. But you'll find in most developments they're very conscious of the product mix. So there's a flavour of the month for that right now, but there'll be key sites that come up, whether it's along Honeysuckle near the harbour or something that's got some great views. And those upper levels, they'll generally put some 2s and 3 bedders in there. It's all about what's feasible for the developer. But when you've got a lot of one type of stock, if there's a limited amount of a new type of stock and it starts selling again, then that's when they create more. So the developers are constantly trying to forecast with the agents on where that's going to be. So I'd say there's going to be a good blend of owner-occupied stock as well as that student and investment type of property.
I might just get your feedback here as well. In terms of commercial property, with all of this development and stuff in terms of residential happening in the CBD, what sort of impact and flow and effect does that have from a commercial point of view for those of our audience that might consider buying commercially within that area as well?
It's really important to look at. Employment is obviously what we put inside business property, so commercial property needs to be located close to people who can work there. On the Central Coast, what we found is there's still a lot of people commuting to Sydney and some to Newcastle, but mostly to Sydney en masse every day, because there's not a lot of employment on the Central Coast for that part of the market. Up here, certainly in Newcastle, I think employment patterns have shifted with what you've got happening with the mining areas and things like that as well. But that's kind of said and done now. Newcastle, the face of Newcastle is changing, and there's going to be a lot more employment with all of this development as well. So commercial property is important to find in an area where there is employment, but it generally won't arise without that employment sort of being around it in the first place.
Great, thank you. Now I've got a question here in regards to the rail corridor, which keeps popping up this evening. We're talking about the train line stopping at Wickham, and a light rail is now being proposed to come in and replace the rest of the CBD area. I've got a few questions here around what sort of impact that's going to have on properties within that area. Mark, I know you've got a lot of new developments coming up that follow that sort of rail corridor. What sort of impact will it have on those properties?
Well, that's the lifestyle and amenity of the whole area. So that's the first thing. There's been numerous studies done around the world about how light rail has impacted a city in a positive way. And you get people that wouldn't have usually used the rail start to use it, so they're actually using their city and starting to use the amenity that's right around them. So there's that side of it. Then there's the fact that it's going to open up what is currently our CBD, which is only just starting to blossom. And it's going to open up to the harbour, which is this touristic and natural resource that we've got. So, there's been people looking at, well, what's it going to be used for? Well, one of the great things that I think that the planning side of the government are trying to do at the moment is trying to engage the community more, and there's been an overwhelming demand for more civic space. And by removing that rail corridor and actually running it down the street that's already there, down Hunter Street, you've got a lot of space that they can put into civic space. So places to hang out, fountains, kids play equipment, pop-up cafes, things along those lines. Will there be some development in there? I'd certainly think so, because it makes sense practically for more people to be living in around that space. And it also makes sense that they can raise some money off those sites. But that just adds to the appeal of having an inner city atmosphere. So I think it's extremely positive that some of that land is being unlocked.
Glenn, do you have anything you'd like to add?
Oh, I think, there's no doubt that while there's good debate about the rail corridor, that it certainly has cut off the developing part of Newcastle from the existing part of Newcastle. So it's good to see it coming back to just being one Newcastle, where people can just transition to and from the foreshore. I think that it'll boost both sides of the old rail. And look, it is the new way of transport. I think if you look in any of the major cities that are developing, light rail is an integral part of that.
Now, Ty, just quickly, I might go down to the Central Coast. We've talked a lot about, what's happening in the residential market of Newcastle and things like that. Are there any new exciting developments that are happening in the Central Coast, Tuggerah area that you might want to share for anyone considering an investment down there?
Yeah, I mean, the Central Coast as a whole is a massive geographic area. Tuggerah is certainly a hotspot at the moment. We've got the Mariners development there, which is $60 million plus development, which is quite large, including the soccer fives. There's a YMCA swim centre. There's a childcare centre, 10,000 square metre office building. Plus, there's going to be a travel lodge, some sort of hotel with basically an eatery around that, 3 or 4 restaurants. That's just in one little precinct. You've got the freeway, and between Westfield and the freeway they own a massive area of land. So there's about 50 hectares of land that's going to be basically subdivided into residential, 2 20-storey apartments as well, another massive bulky goods area. There's also a 500 million odd development that's in the area as well. It's going to be basically smaller residential lots, a touristy sort of thing. And I mean, I can't go into a lot of detail with that because that's in the early planning stages, but it's in that general area. And so you've got a 5 kilometre radius with massive development happening for that area. I mean, it's nothing like what's happening in the centre of Newcastle, because Newcastle is a major city in Australia. The Central Coast is not a major city, but it is large regional development, large-scale regional development definitely there.
So we're still going to have you as the neighbour soon?
Yeah, definitely.
Perfect. Now I've got quite a granular question. This one's sort of relating to the Cameron Park Wallsend Estates. Now that the expressway's opened up, what sort of impact do you think this will have on rents and rental properties, investment properties, that sort of thing in those estates? Wayne, I might throw this to you because I know you've got an agency opening up in Wallsend shortly.
Well, I mean, the Cameron Park, that growth corridor out there through there, I mean, that western area is the growth corridor of both Lake Macquarie and Newcastle. I mean, it is the only area where residential land can be developed in both Newcastle and Lake Macquarie can go out the western area, but that is the predominant areas. For Lake Macquarie, Glendale and Argenton, that area around there is an enormous area of growth and will probably become the focal commercial sector of Lake Macquarie as well around there. So, with the freeway on the doorstep there's still a lot of people transitioning both north and south along the freeway, so you'll probably see the residential area grow right out to the edge of the freeway over the next 10 years. From a Newcastle point of view, well, we've heard about the possible rezoning of land out through Minmai, a lot of that coal and allied land, and also up through the back of Black Hill, which is sort of bordering on the Maitland district. So that freeway is an integral part. You'll find these days that the state government especially is pushing for growth along transport corridors, where there's even discussions about building over rail corridors in through Sydney, where people can virtually just go downstairs, hop on a train and go into the CBD. So transport corridors are integral to the future of development.
I wish I had that when I lived on the northern beaches. Alright, so we've talked a bit about some positive stuff. I now thought we might touch on the property spruikers type of thing, which is probably not as positive. Wayne, you and I have spoken in the past where you've had instances of clients coming to see you following property developers, putting people into over-promised properties and promising to over-deliver, and it's not being obviously delivered on. For those people might be considering or have this sort of presented to them, what sort of tips would you give them to put in place to avoid being taken down the wrong track?
Yeah, well, first of all, Mark and Ty would agree that, as real estate agents, we work in probably one of the most highly governed legislative arenas that there is in the country. So, and the licensing regime, that's very tight. But there are people that work on the edges of these regimes that are possibly not licensed under the Property Stock and Business Agents Act and not licensed under the Financial Services Act, that go out there and encourage people to buy property. Now, what we've found over the last 5 or 6 years especially is that some of these spruikers charge enormous fees. I mean, we're hearing fees of up to $50,000 on top of the cost of getting into them, so whether it's house and land or apartments. And the problem is that a lot of these costs are hidden, they're not disclosed, as we have to disclose all of those fees that we were involved in. And for the investor, their fees that are taking up their future equity, sometimes it can take 4 or 5 years to gain that back in equity, apart from the fact that the investment potential simply isn't there. We're seeing devastation in areas such as the Upper Hunter through Singleton, through Muswellbrook, where where rents they were getting for a package that they paid $500,000, they were getting $600 a week. Now they're struggling to get $400 a week, and there's literally hundreds of properties left unrented. So
And
dangerous stuff.
have you got some horror stories there you can share?
Yeah, well, those particular sort of two-tier marketing schemes, if you'll see it, they sort of have a lot of hype surrounding them. So it's always good to actually, even if you get told about an area, and you do have a lot of faith in what that potential, let's not say Spruker, let's just say you've come across an investment network, it's good to talk to the local agents on the ground in that area and say, look, how does this stack up? How does this compare to something that you might be able to offer? Just like you would when buying a car, especially if you haven't been into that area before, because one of the things that can happen a lot of the time is that there's an estate that might have had great potential, but that areas adjoining it only have, say, 15-20% investment property, and then the rest of them are owner-occupiers. They then go and fill an estate with investment properties, and you've got 50 properties at the same time trying to rent out. Now, the ones in the adjoining suburbs may well have got $450 a week, but there's only 15 homes in there renting. You put another 50 in there, and the supply and demand, which is that critical factor that drives rental and sale prices, is totally washed out. On top of the fact they paid more for that property than they needed to. So you're talking a long-term recovery period just to get your money back.
And Ty, do you see this happening in the commercial industry?
Not so much in commercial, but I do see it still happening in residential, and I can think of examples of large companies that are turning over massive hundreds of millions of dollars a year that are just absolutely skinning people alive, but doing it in such a way that it looks like they're helping them to grow their portfolio and their nest egg. And whilst it's wrong, that part of the market is not as governed as, say, what we do, or childcare industries, for example. There's a lot of industries out there that are heavily governed, and I understand you've got to take care of kids, we've got to take care of our clients, we've got to disclose everything, there's no secret commissions or anything like that. But when you get on the edge of development, it's very, very easy to palm off large fees to get people put into things that they don't even come and see half the time, and they believe that they're going to be getting rents like that for a long period, and they won't, because it's supply and demand.
Interest rates. They've been low for a very long time now. I'm sure you've all got an opinion on maybe how much longer you see these staying at this low level. Do you want to go with Mark first, using your ideas on interest rates?
There's a few property economists that have a very close tie to speaking about interest rates. Dr. Andrew Wilson's a good one to follow. He speaks on Domain a lot in Australian Property Monitors. And look, the last few forecasts I've seen tend to think that it could be around 12 months, kept at a very similar rate. But either way, we're at an all-time low with these interest rates at the moment. You can lock them in if you want that sort of security, and it's just a great time to be getting a positive cash flow from a property. But I maintain that a great investment property's got a 20% deposit in it. So that if you're only borrowing 80%, you don't have the mortgage insurance most of the time. And even if the rates go up a little bit, the rents tend to go at a similar sort of rate, but even if they don't, you can generally still cover the majority of that outlay on that property when you're 20% in. So I don't watch it as closely as I watch the good old supply and demand.
Wayne, is there anything you'd like to add?
Yeah, look, there's so many things these days that govern interest rates, and we hear about them on the breakfast shows. But I think we've still got a good period of at least 12 months of low interest rates before we start to see the curve turn. Because the economy has still got some problems throughout it. I mean, unemployment's still rising in various sectors. The retail sector is still suffering greatly, although improving in some positions. I mean, the construction industry improving is a good sign. If it continues to improve, you'll probably see that there'll be pressure then for interest rates to go up.
Mark just mentioned that generally rents will go up in line with interest rates somewhat. Does that happen in commercial real estate as well?
It does. The thing that you've got to understand with borrowing for commercial property is you need to put much more equity into the loan. So you basically have a lower proportion of equity against debt in residential typically. The returns that you get alternatively though with commercial property are much higher. So you're looking at typical, if you've got a 5-year lease or a 7-year lease or a 10-year lease, you might get somewhere around circa 8 to 9% return. You probably lock a loan in at 5.25%. So I think the low interest rates are basically going to stay low for probably a little bit longer. I would like to think maybe another 2 years, but it could be 12 months. But for commercial property, if you can get a good lease, it's more about locking that in so that you know how much rent you're basically going to get. Rents and capital values with commercial property are driven by different things. So yeah, I think really focus on just getting a long-term lease with a rent that you know is going to be sufficient to pay the loan, and then locking a low interest rate now. That's probably good advice.
Great, thank you. Now, just quickly before I get each of your hot tips to finalise the evening, I'd like to open up a couple of questions to the floor. Is there anyone that has any pressing questions they'd like to put forward?
Just one question.
Damien?
Just the effect of the ageing market. So you're talking about the development of the CBD in particular, and the 1 and 2 and 3 bedroom places. I assume that the appeal of that has also got some drivers with the ageing population. Do you see that as people moving out of the Sydney areas, looking for more, nice place to live? Are they seeing, Newcastle finally as that sort of place in the CBD?
Yeah, look, it's interesting. My parents have just sold out of a house in Hamilton South. The typical 550 square metre block, big house with a pool, and they're into a top floor apartment in town, getting amongst the lifestyle and locking it up on the weekends rather than spending time on the edges. So there is definitely a shift towards that, but what's driving that is the amenity. So the amenity of the city is bringing people out. You can now go through Newcastle and there's something like 15 different sort of wine bars, after dark venues for mature people and visitors to come to town. There's good food, there's tappers, there's people opening their doors to make it a more interesting place to hang out with your friends and to visit and to live. So you do need those catalysts first to drive it, but we do have an ageing population as well, and as we know, the baby boomers have a very good proportionate savings compared to some of the other demographics out there.
You kept looking at me when you were saying that.
I'm not going. I'm looking at you to see it's
Do you get my credit card statements?
Yeah.
Are there any other questions? Okay, quickly while we finish up, I'd just like to get from each of you, if you can say one thing to the audience tonight as either a forecast or hot tip for them to take away. Do it in under 1 minute, and Ty, I'll start with you.
Buy commercial property. Honestly, there are really great areas in the area that I know, and I do know my area well, but there are great areas in every different part of the country to buy commercial property, and I'm not saying put all your eggs into one basket, because I totally agree that your principal place of residence is the best tax haven that you can possibly get, and that's where you should have probably most of your money. If you put, people say, put all your black money into your principal place of residence, because it just disappears. If you can build gold and sandstone walls in there, the government doesn't know where it comes from. I know that might be borderline, but it's true. If you put money into your principal place of residence, it's a fantastic way to save. And if you put money into commercial property, it's a fantastic way to get a return. So long-term leases rather than short 12-month leases or whatever you get in residential are very beneficial because they allow you to plan.
Thanks, Ty. Wayne?
Oh, look, I think probably when you're looking at it from an investment point of view, do your research well. Look for areas where you know that there's not only good infrastructure going in now, but good future infrastructure going in, along all sorts of infrastructure, where not just from a point of view of rail lines and that, but large transport links, future employment growth, all that sort of thing, and speak to your local people. I think that's a big thing for me, is make sure you talk to local people who know the area well.
Great, thank you. And Mark? 1 minute, remember?
Yep. Now, if you've already got an investment property, I'd urge you to have an assessment on that investment property and see how it's already performed and if there's something that could be possibly performing better. When people say it's a good time to buy or sell, well, it can be a good time to sell and buy. There could be a more preeminent area that's got a lot more growth in front of it. So I'm always happy to look at something that someone's got that they've had for 5 years, could have already had some good growth, could be some good equity there, but it could have slowed down compared to another area that's just about to go. So I'd say assess those investments and look at the drivers rather than just the individual bricks and mortar.
Fantastic. Thank you very much, guys. Can you please join me in giving them a big hand? Now, I know some of you had a couple of property through super questions, but we're trying to keep this just about, the community of NFP and, our business partners and a light bit of education. So if you do have questions, we do have 4 specialist SMSF advisors here this evening, and we do invite you to join us for a drink at the bar, so feel free to approach them with your questions. Thank you.
I just wanted to finish off with, I guess tying this into, why tonight and why property, from a financial planning company. And it's part of our culture at Rethink Newcastle Financial Planning is to educate our clients. It's really important for us to give our clients that opportunity to hear a diverse range of experts. And so tonight that's what the opportunity was for us. It was to share our knowledge and share the collective wisdom of those business partners that we work with, such as Ty and Mark and Wayne tonight. So again, thank you, and thank you to everybody who has joined us this evening. I hope to see some faces back again next time round. Please enjoy. Thanks, Eddie. I know, it's infectious, isn't it? I'm going to take it to the office. So yeah, enjoy this evening. Please feel free, as just said, to engage with any of the teams that are here. Any questions that you have, please don't hesitate to ask. And thanks again for coming out. Good evening.